And for all the frenzy around AI, there's a quiet investor backlash building against the tech oligarchy's recent stock market run, and T. Rowe Price Group Incorporated, and then Bank of America Corp. And Citigroup Incorporated are among those who reckon the hype around all things artificial intelligence is topping out. But they contend that that's not bad news for the market. Because so-called cyclicals, old economy companies such as banking and mining are primed for a rebound. But such stocks have been elbowed out of the way in recent months by the stampede for AI-linked stocks such as NVIDIA Corp. And Advanced Micro Devices Incorporating with record investment flows. These stocks have led the NASDAQ 100 benchmark to its biggest ever outperformance against the Russell 2000 small cap share index. To illustrate the divergence, a $1,000 investment made on January 1 on the NASDAQ would have earned a return of $330, while a similar amount placed on the Russell index would have earned nothing. And nonetheless, small caps are beginning to regain ground. This week's rally in the Russell 2000 has surpassed moves in the NASDAQ by nearly 5%, as a growing band of investors wagered at beating down cyclicals will reap greater future reward than frothy tech. That's because they believe expectations of U.S. recession and interest rate cuts, a powerful driver for tech stocks, are way overdone. Sebastian Page, Chief Investment Officer at $1.35 trillion asset manager T. Rowe Price, has been snapping up small cap stocks on a view that markets are overestimating recession risks. Right now, the pulse is more toward a soft landing. Page said in an interview, "These assets look really cheap, and this is an opportunity to lean in when no one else is ready yet." Some are also skeptical a rally built around mega-cap stocks can endure. The S&P 500 is teetering on bull market territory, but may saw more stocks hit 52-week lows than 52-week highs. Market narrowness is at extremes, and the 5 biggest stocks in the index, notably all of them tech names, now make up nearly a quarter of the index by market cap. It's an unbelievably concentrated market rally, Page said. A handful of stocks are up, and the rest of the market is basically flat. Some long-standing tech fans are also lightening up on positions. Edmund de Rothschild Asset Management has trimmed its NVIDIA overweight, held at least since 2020, citing lofty valuations across AI tech and program. Cyclical bank and mining shares enjoyed a bumper 2022, benefiting from higher interest rates and post-COVID normalization. But as U.S. banking turbulence in March stoked fears of a severe downturn, investors rushed for so-called growth shares, which benefit more when borrowing costs fall. Value investors find life at the top was brief with AI ascendant, but many economists now expect a recession to be shallow and short-lived. Bank of America Corp., for instance, sees a 0.8% peak-to-trough GDP decline, and Savita Subramanian, its head of U.S. equity strategy, says the U.S. debt ceiling resolution, alongside a tight jobs market, set the stage for a less dire recession. She expects cyclicals to lead markets higher from here, rebounding off the biggest positioning underweight since 2008. Similarly, a Citigroup and Clexa team led by Scott Kroner is urging clients to allocate sidelined cash to cyclicals, predicting cyclicals within the S&P 500 will gain market capture at the expense of growth. And Kroner's recommendation is partly based on the valuation gap with the NASDAQ 100 trading about 30 times forward earnings versus 20 for S&P 500 cyclicals, and he too expects a mild downturn with less shock effect than previous episodes, given defensive positioning across much of the market. Despite his bullish view on cyclicals, Kroner acknowledges the difficulty of fighting the AI tailwind, and so he advises those already invested in tech to hold on to positions, while warning another country the rally is too far gone for new investors to join. Momentum remains strong but difficult to chase, he added. Meanwhile, economic data has been mixed. Key metrics are beating expectations. A gauge of economic surprise shows as labor and housing markets slow, but only gradually. But inflation isn't magically cooling as quickly as hoped. While a key recession indicator, the Treasury yield curve, continues to flash warnings. That poses a dilemma for anyone looking to position for a cyclicals rebound. All the more so if they were burned earlier in 2023 by the market's sudden pivot to tech. The Texas investment managers were among those caught holding an overweight on financials and value stocks earlier this year. Despite doubts over the AI-fueled rally, they are hesitant about committing more money to cyclicals. Different things keep becoming the flavor of the month, and there's very little trend, said James Beaumont, head of multi-asset portfolio management, in an interview. We haven't put our chips on the table yet.